Hello, everybody. Welcome back to another episode of Main Street Money, where Wall Street meets Main Street. I'm Andrew Gay.
And I'm Zach Green.
As always, our goal here is simple. We take what's happening in the markets, the economy, and the world of financial planning and translate it into something useful for everyday investors. Now, we're recording this while the markets are still open on Thursday afternoon because tomorrow is Independence Day. Well, Saturday is Independence Day, but tomorrow we are closed and it wraps up a shortened trading week. So some of these numbers may move around before the closing bell, but assuming we finish roughly where we're at right now, this has been a decent week for investors. The biggest story wasn't inflation. It wasn't the Federal Reserve. It was this morning's jobs report. And interestingly enough, even though the headline payroll number came in softer than expected, investors largely viewed it as good news. Why? Because it suggests the labor market may be cooling just enough without showing signs that the economy is slipping into a recession. So let's jump right in. Segment one, markets finished the holiday week strong. Assuming we finish near current levels, all three major indexes are wrapping up another strong week. The Dow Jones Industrial Average is hovering around 52,750, up roughly 2% for the week and about 9% year to date. The S&P 500 is around 7,540, roughly 3% up this week and about 9.5% up this year. And the NASDAQ has bounced back nicely this week, up about 4% on the week, leaving it roughly 12% higher year to date. Considering everything investors have navigated this year, from inflation concerns to interest rate expectations, that's a pretty impressive first half of the year.
Yeah, what I think is encouraging is that the rally continues to broaden out. It's not just a couple large tech companies anymore. We're seeing participation from financials, industrials, communication services, healthcare. And historically, that's usually a healthier sign than relying on one sector to carry the market.
Yeah, and I agree. Broad participation generally gives more confidence that the rally has stronger fundamentals underneath it. Zach, one question we hear all the time when markets are making new highs is now a good time to get out of the market? How do we usually answer that question?
Well, that's probably one of the more common questions we get. And the answer is usually that if your long-term financial plan hasn't changed, your investment philosophy probably shouldn't either. Trying to jump in and out of the market is incredibly difficult, even for professionals. Now, that doesn't mean ignore your portfolio or anything like that.
Right.
It may be a good time to sit down with your advisor, review the allocation, and determine whether there are any tactical adjustments that make sense based on your goals and risk tolerance. But that's very different than abandoning a long-term investment plan because of a headline.
Yeah, successful investing usually isn't about making dramatic moves. It's about making thoughtful decisions and staying disciplined. And we know that. We talk about that all the time on here. Segment two, the jobs report stole the show this week. Now let's talk about what really moved markets this week. It was the employment report this morning. Headline payroll growth came in around 57,000 new jobs being created for the month of June. That was below expectations of roughly 110,000 jobs. At first glance, that might sound disappointing, but when you dig a little bit deeper, the report actually painted a healthier picture. The unemployment rate improved slightly by 0.1% from 4.3 to 4.2%. Average hourly earnings increased 0.3% during the month and 3.5% over the past year. So wage growth remains healthy without accelerating dramatically.
That's why you've heard people describe this report as cooling without cracking. Hiring is slowing a little, but employment remains low and wage growth is still positive. That's a very different reason, or very different from what we'd expect if the economy were headed towards a recession.
Yeah, and investors seem to like that combination. Stocks rallied, Treasury yields moved higher on the long end of the curve. The curve steepened, all signs that investors came away feeling a little more optimistic about the economy. So Zach, when you look at today's report, what was the biggest takeaway for you?
For me, it reinforced something we've talked about for months. It's dangerous to focus on one headline number. If someone looked only at payroll growth, they might think this report was weak. But when you combine that with lower unemployment, steady wage growth, the picture looks much different. That's why we always encourage clients to look at the entire story rather than one statistic.
That's such a good point. Economic reports are like puzzles, I think, in some way. One piece rarely tells the whole story. Segment 3, the bond market is paying attention. Another interesting development this week happened in the bond market. The 10-year U.S. Treasury yield moved back above 4.48%. The 30-year Treasury climbed back towards 4.98%. Both increased roughly 2% on the week after falling below those levels last week.
That's a good reminder that bonds are constantly repricing expectations. Higher long-term yields this week suggest investors became a little more optimistic about future economic growth after the jobs report.
And we also saw the yield curve steepen a bit. Now, that's one of those Wall Street terms that sounds really complicated, but really all it means is that long-term interest rates increased a little more than short-term rates. Markets are essentially saying they're becoming somewhat more optimistic about the long-term growth picture. Current market pricing now suggests roughly 42% chance of 1/4 point rate hike before end of the year. There's about a 27% chance of 2 rate hikes by the end of 26, and roughly 30% chance that the Fed funds rate is still about 50 basis points or 0.5 percentage point higher than today by next June.
It's amazing how much those expectations have changed over the last 6 months. Earlier this year, everyone was talking about rate cuts. Now the conversation's completely shifted, and it's how long will rates stay elevated and will they go higher?
Yeah, markets are constantly adjusting for the new information that becomes available, right? So that's why trying to predict every Fed meeting usually isn't a winning investment strategy. Segment 4, Financial Planning Corner. Don't let the news manage your money. Every week, we try to connect what's happening in the markets to something practical. This week, I want to talk about headline investing. Think about just the last few months: inflation, interest rates, tariffs, Middle East tensions, jobs report, Federal Reserve meetings. Every week, there's another headline telling investors they should either buy everything or sell everything.
Yeah, and if you reacted to every one of those headlines, you'd probably spend more time changing your portfolio than actually letting it work.
And that's a really good point. One of the biggest mistakes investors make is confusing information with action. Just because something happened today doesn't automatically mean your financial plan needs to change tomorrow. Zach, when someone calls us after a big market headline, what's usually the first thing we encourage them to think about?
The first thing is usually to ask, has your financial plan changed? Has your retirement date changed? Has your income need changed, or your risk tolerance maybe? Because if the answer to those questions is no, then there's a good chance the portfolio shouldn't change dramatically either. Now, that doesn't mean we never make adjustments. Sometimes it's appropriate to rebalance or make tactical changes, but those decisions should come from your financial plan, not from fear or excitement created by one of today's headlines.
And that's exactly the mindset we try to instill with our clients. Good investing isn't about predicting every headline. It's about building a portfolio that's designed to withstand lots of different headlines. Segment 5, the big takeaway this week. So let's wrap things up. This week's jobs report reminded investors that good news can still be good news. The labor market appears to be cooling without falling apart. Consumers continue to spend, and businesses continue to hire. Corporate earnings remain strong, and investors responded positively.
I think the biggest lesson this week is that markets don't require perfect economic data. They just need an economy that's continuing to move in the right direction.
That's exactly right. If there's one takeaway this week, it's this: don't build your investment strategy around one jobs report or one headline, either for that matter, one Federal Reserve meeting or just 1 week's worth of headlines. Build it around your long-term goals. Markets will change, interest rates will change, economic reports will change, but a disciplined financial plan that's built around your objectives shouldn't have to change every time the news cycle does.
Yeah.
Zach, thank you for joining me.
Yep. Thank you.
And to all of you, thank you for joining us for another episode of Main Street Money. From all of us here at Texas Hill Country Advisors, we hope you have a safe and happy 4th of July weekend. Don't forget, interact with us, share our content. We're on Facebook, LinkedIn, and YouTube. We'll catch you back here next week. Happy 4th of July. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.